Good morning, everyone. This is Rashmi Shah from Simplicity Investing. Um, I'm doing this webinar from Dallas, US. Um, Before we start, I just would like to make a few announcements. We have changed the name of our company from Simplicity Investing Advisors India Private Limited to just Simplicity Investing India Private Limited. Uh, yeah, and the disclaimer before I start by today's talk that this we are not promoting any products or investment uh, on this webinar, and this webinar is only for people in India, and it's only for the purpose of knowledge. Yeah. Now, with that, I start by today's talk. Now, as in every webinar, I start with the market update, what happened in the market in between the last webinar and this webinar. And so as we see, the number of corona cases and the stock markets are both showing signs of recovery in India, but that's not. So from India's perspective, that's a good news. Now, the markets, as you see that, in Indian markets are still underperforming the US market recovery. But the Indian market has recovered from January 1st. The Nifty was 12,182 and now it's 11,930, just 2% shy. It's just -2. Whereas NASDAQ has gone up by 30% from January 1st till what it closed on Friday, 11,548. So it has given 30% return, whereas Nifty has given -2%. S&P 500 has given 6% return. Dow Jones has given, again, same with Dow Jones and Nifty, they both have given -2. They're in together. And Japan Nikkei has given 1% return if I take from January 1st. Now, the rupee has depreciated by 3%. And against the dollar, and 7% against the Japan Nikkei, correct? Japanese yen, 7%. So overall, if you see, the Indian market has underperformed NASDAQ by 30 plus -2, so 33% it has underperformed. It has underperformed S&P 500 by 10%, underperformed Dow Jones by 10%, and has underperformed the Japanese Nikkei by 8%. So Indian market is still underperforming. Now, this is the underperformance on the previous 3 webinars. So if you see today we are still underperforming by -35, and India has not started outperforming in last 1 month. I expect India to start outperforming the US markets in next 2 to 3 months time, over a period of next 2 to 3 months. That's my guess, but that's again a guess. Now, coming back to the US market, the US market has recovered sharply, and we have a US election in 10 days. Now, the market is predicting that the Democrats, Trump is going to win, and Joe Biden is going to be the next US president, and Donald Trump is likely to lose. That's what the market is predicting as of today. And with that, if Joe Biden comes, we will see huge stimulus, and further liquidity in the market. They will be pumping at least $2 to $3 trillion in next 2-3 months time. And when they pump that kind of money, you will see the market recovery even sharper in the US market. That's what the market is expecting. That market is what it's pricing. So next 2-3 months are going to be very interesting for the financial markets worldwide. As far as the COVID is concerned, the number of cases in the US has spiked sharply this week. Today, the count came was 80,000 new cases in US, which was the highest. So the second wave of COVID has started here. So next, they say that next 2-3 months are very critical from COVID point of view to US and Europe. Whereas India is recovering, the cases have spiked down. Let's see, India doesn't get this kind of a second wave like what the world is experiencing currently today. But it's going to be interesting times for next 2-3 months time. That's what it is. Now the COVID. So as coming back to COVID, correct? COVID has not going anywhere for next 2 years, even if vaccines are coming. It will take at least 2 years, minimum 2 years for world to get COVID free. Minimum 2 years. I mean, some say that the COVID is going to be there for now permanently like flu. So with that, the COVID has changed the world drastically. Humans have changed drastically. COVID has made the world economy as one digital economy. Then the savings rate of people worldwide has gone up. Even the Americans used to save 8% of their income before COVID. Today they save almost 15% of their income. So almost savings have doubled. Then asset allocations have changed. People are now more allocating more money to financial assets than real estate or other assets. Again, companies, how they finance. More and more companies are going through equity finance, raising more equity than debt. And it's very difficult for small and mid-cap money companies to raise, get debts, and very difficult. So these are some of the changes which are happening, and I won't go through the other changes like supply chain disruptions, and every country is focusing more on local buying, like Atmanirbhar India. America says make America great again. Every country is focusing that. Those are political slogans, but still the world economy, globalization is going to increase. It's not going to reduce. So these are some of the permanent changes which are happening in the world. Now, the financial markets also have changed permanently. The way financial markets were performing 2 years back, they are not going to be there. Now, let me share some of the trends which I see in the financial market. Interest rates on fixed deposits have gone lower. So what is happening because of that? The more people are looking for other options, and more people are coming to the stock markets for investing worldwide, especially the younger generation. Younger people below the age of 35, they are getting more attracted toward the stock market. Then there is an increase in savings rate. As because of the increase in savings everywhere, banks worldwide are flush with funds, and they are reluctant to loan money because of defaults in so many cyclical industries. Allocation to debt funds have increased. In last 1 year, the debt funds in US have got about $7 to $8 trillion more money. It's a huge money. So $7 trillion is almost 2.5 times of India's market cap. So can you imagine that kind of money has flown into the debt market, and money has gone out of the equity markets in the US. Almost $300 billion people have sold stocks and moved the money back to. So a lot of people are waiting for market to correct so they can buy the stocks. So that's the story here. Worldwide, that's happening. I'm sure in India also a lot of people are waiting for markets to correct so they can pump in more money in equity markets. Now, the value investing has underperformed growth, as we have seen. So I'll give you a classic example. All market cap of all the oil companies in America, like ExxonMobil, Chevron, the biggest oil companies of the world, they are in the US. And if you take the market cap of all the oil companies listed in US stock market, is less than the market cap of Facebook. Then if you take, I'll give another example. ExxonMobil, the annual revenue is $225 billion, and revenue of Zoom, that Zoom is only $665 million, but market cap of both the companies is $245 billion. So imagine Zoom has only 0.5% of total revenue of ExxonMobil, but the market cap of both the companies is same. So what it means is that value investing, oil stocks are value investing, they are out of fashion, and growth stocks like Zoom, they get much more higher value. Technology stocks are getting better. So this has happened worldwide. Now, what it tells you is that the future lies in this kind of companies, technology companies. The future growth is not going to be the oil. So it does not mean that oil companies won't exist. They will exist, but there is not going to be a more growth, and the stock market likes growth, correct? So valuation, so that has happened, and because of this, a lot of people have been caught, correct? A lot of mutual funds, a lot of investors, they still have old habits of investing in value, and the value is underperforming today. IT, healthcare, and FMCG has rallied. Now, as we are all aware that pharma stocks in India have rallied almost 50 to 60%. Now, let me give you a little bit update on that. Pharma stocks will continue to rally, and IT stocks will continue to rally. The reason I'll give you, for the main reason for pharma, there is an acute shortage of drugs in US. So what all the critical drugs, there is a shortage. So what the US government has given directives to all the major US pharmaceutical companies, that they should move, because the production capacity is limited in America. They said you focus on COVID related drugs, and all other drugs which you were manufacturing before, shift that production to Europe or to Asia. So they are moving all that to. So India is going to be India is a very big beneficiary, and India is not the largest exporter of drugs, but India is one of the major exporters of the drugs. So whatever extra capacity Indian drugs have, they are fully booked. They are fully booked for next couple of years. So that's why pharma stocks are going to still have not peaked up. They should give still good returns for next 2 years, till the time the drug shortages and the COVID is resolved. Now, even IT stocks, as long as the COVID is there, the demand for work from home and IT infrastructure is going to be there. The world has become digital economy. Everyone has not still become digital. Still, there is a lot of things to have. A lot of digitalization has to happen in India and other countries and all over the world. So the demand for them is going to be much more higher. And then allocation to financial assets is going to increase. Now people realize the importance of financial assets. When lockdown was there, people who had financial assets, they felt secure. They could use that money and live peacefully, whereas those whose assets were all blocked in real estate, they panic, correct? So the importance of financial assets has suddenly come. The other major trend we have seen is, in last 1 year, thematic funds have been outperforming the generic funds like large cap, mid cap, balanced funds. Now, because I'll give you, in normal times everything goes up, correct? But these are not normal times, these are extraordinary times. And during extraordinary times, when there is total chaos in the world, only certain segments, certain sectors, they perform well, and like IT, pharma. So thematic funds have been doing way outperforming the generic funds. Now I'll give you the other perspective also, between value and growth. Value stocks perform well when the world is stable and there's normal growth. When everything is normal, then people start comparing the values of different kind of companies, correct, based on the balance sheet, and then that's time the value stocks perform. But when the entire world is getting disrupted because of technology and COVID, during those times, growth stocks perform. So it's like this, correct? So when there's weather is normal and you go to buy vegetables or any shopping, you have a lot of time and you negotiate the price, you ask for the price and you compare. So let's say normal times you want to book a cab and you ask the cab driver how much you're going to charge me for taking from Pune to Bombay, and you negotiate that. But let's say when the thunderstorm comes and you have to save your life and you want to go to Bombay from Pune for some emergency meet, you don't negotiate that time. You tell the cab driver, take me to Bombay at whatever price, correct? So that's growth, correct? That time there is a shortage. So same thing happens in the stock markets. During normal times, value stocks work. During abnormal times, when the whole world is getting destabilized, growth stocks perform. And growth sectors, I would say growth sectors perform, correct? So now the other thing which has also come to everyone must have experienced in India, that Indian investors need to invest more globally to get better returns. Of course, Simplicity has been promoting and global mutual funds to everyone and global investments for the last couple of years. But investors are realizing that India needs to be more globalized. Indian investors need to be more globalized. So in the coming 2-3 years, you will see more and more global funds coming to the markets in India. That trend you will see. Young generations are getting more attracted to the stock market, which is a good sign, which is a very good sign. Normally, young investors 3 decades ago used to start with LIC policies and those kind of investments. Today they start with mutual funds, or stocks, which is very good, correct? Then debt-free companies are doing well. That's the other trend we are seeing, and more polarization in the market. Again, I'm saying every sector is not performing. There is a more polarization in the market. And this polarization is going to continue. We are not going to see broad-based rally that every stock or every sector goes up. Those kind of stuff is not going to become norm, at least for next 2 to 3 years. So financial markets have drastically changed, and which we need to understand, correct? So now coming back, so that's one of the reason I've chosen this topic today. See what we have experienced in last couple of months. There are people come with all different kinds of questions, correct? So based on that, I said, okay, let's talk about, people think direct equity is much better than mutual funds, or people have those kind of biases. So I'm going to share certain things, why we chose this topic and what experience we see in the market. So currently today, if you want to participate in capital market, you can participate through direct equity. You can buy stocks directly, or you can buy invest in the stock market through mutual fund. And there is a hybrid. Hybrid means a mix of direct equity and mutual fund is electronic credit funds, which is a mix of both. So ETF you buy like a stock in the stock market, but that ETF is not one stock, it's a combination of stocks, correct? It's a basket of stocks. So that's why it's called electronic credit funds. These funds are traded live like a stock market. So there are 3 options you have, and then the 4th option is you go for PMS schemes, correct? PMS schemes or closed-ended funds. Now, so these are the four options you have, but I'm going to focus more on the first 3 today, more this, because PMS I don't consider as a good product at all. PMS is for very, very sophisticated investors. In India, PMS limits are very low. If you see in America, people go for PMS only after $50 million or $100 million, which is a huge amount, not for regular investors. Now, as I said, ETF in India today, you can invest in ETF like a stock, correct? So, which is, now let me give an example. Let's say you are bullish on FMCG sector. If you are bullish on FMCG sector, so you pick up a stock like Hindustan Lever. You want to buy Hindustan Lever. Now, you have 3 options to invest in FMCG sector. You can buy Hindustan Lever stock, or you can buy FMCG ETF, which has Hindustan Lever, Nestle, Colgate, all those stocks to be Dabur. So you buy a sector, and the third is you buy a mutual fund. Now, so in a mutual fund which has Hindustan Lever, Nestle, and all. So the difference between all the 3 is, when you're taking a Hindustan Lever stock, you're taking more risk because you're picking one stock in that sector out of 20 stocks. When you're buying an ETF, the ETF has a fixed component, and it's managed by the computer. It's not actively managed, it's passively managed, correct? So you buy a certain percentage of Hindustan Lever, Nestle, and together your risk reduces compared to buying a direct stock, because in direct stock you are taking much more risk by choosing one stock over other stock. And then ETF, the risk reduces. But it's passively managed. Now, you want to reduce the risk further, which is actively managed, you go to a mutual fund. A mutual fund is more, a person is monitoring that, so he is making even more. So there are three layers, correct? You go through a direct equity, you go through a ETF, or you go through a mutual fund. Now, which is good for you? Now, you'll ask, which is good for you? So let's see. So I'm going to share my experience, which is good for you and how you should react to it, correct? How should you use this? Now, in investment planning, there are four things required, correct? You understand the market, the platform through which you're going to invest. Then there's an intermediary who's going to work with you, like your stockbroker, your mutual fund distributor, and platform is what platform you're going to invest, correct? Mutual fund platform or stock platform, NSE platform, and how you react to different situations in the market. So when you want to build a portfolio, these four critical factors are important. So when we work with clients, we look at all these four things, and we work with you and we guide you in building the portfolios, correct? So depends on every person is different. Markets change over a period of time, and how you react on different situations, that's very critical. So based on that, you have to choose which is the best investment vehicle for you. So the key is so in case of ETF, what plays the most important role? Your emotional intelligence, because here the timing becomes very important. You try to time the market. Whereas in mutual fund, you don't try to time the market. Your SIP, on 10th of the month, automatically the money goes, whether the market is up or down. But in ETF, that's not the case. You have to place an order, you buy. So you try to time the market. Now that requires a lot of emotional balance, correct? Oh, markets are going down, I'll wait. Markets are going up, oh, I should have bought when they were low. So then that conflict is there. So this determines, that's the big difference between mutual fund and ETF. The other difference between mutual fund and ETF is when you buy an ETF, you buy at that particular moment of time what price is available to you. A mutual fund you get, suppose today you decide to buy a mutual fund today and ETF today. So when you buy an ETF, you buy an ETF at 10 o'clock in the morning, you see this price on the screen, you get at that price. Like you want to buy FMCG sectors ETF. So you see the price and you buy at that price. Now you want to invest in mutual fund, you get the NAV of the end of the day, not at 10 o'clock in the morning. Though you told your intermediary mutual fund distributor to place the order at 10 o'clock in the morning, but you are going to get the NAV at 3:30, whatever the NAV is, that price you're going to get. So when the markets are volatile, so ETF, you come to know what the price is. In mutual fund, you come to know only at the end of the day. So that's a big difference between the two, correct? And equity also, you are taking even more risk because you have to pick a sector, then you have to pick a stock. Whereas in ETF or mutual fund, you pick up a sector, you don't pick up a stock. So the risk reduces, and the second risk here is what sector you pick up, correct? What sector you pick up and what is the strategy? Now strategy, are you going to invest in ETF one time and forget it, or are you investing every month? Now when you're investing in every month, again it requires you can't buy an automated ETF, correct? There is no SIPs in ETF. You have to physically place an order. So that's a big difference compared to the mutual fund. So here in mutual fund, process and strategies play major role. Here they play the least role. Now the returns, what we have experienced in my experience in the last 30-40 years, that the person who focuses more on process and strategies get higher return than the person who focuses on timing the market and managing the market. So if you see, I have seen in my, even in my personal case, I have made more money investing in mutual funds and ETFs than compared to stocks. Because when I try to invest in stock market, even I become a human being and become emotional, correct? And I make mistakes. So if you want to build a portfolio, my number one choice is this mutual fund, number two is ETF, and number three is equity. But many of the, I have experienced many clients in India, people think that direct equity is the fastest way to create wealth. That's not the case. But we don't stop people from doing that. We provide all the three products, and we provide all the, and with experienced clients understand which is better for them, and then they switch, correct? So we don't try to push them, but this is the experience has been. And that's why I want to share the advantage and disadvantage of everyone. I'm going to go in more details further. The markets, correct? Now, as I said, market, everything is not going to go up. So when you are investing in the markets today, you need to decide which country you're going to invest, a geographical diversification, then within that which countries, which sectors you're going to invest, and then what quality of investments you're going to do. So this becomes important. So most of the people in India, they invest in only Indian. So their focus is geographically is only in India. Now Indian stock market is only 2% of the world's stock market. So you're ignoring 98% of the world's market. Now out of that 98%, 40% is US stock market, and which leads the world stock market. Now, if you don't have any exposure to that, that means you're missing the most. Like, in India, if you see the five biggest stocks are TCS, Hindustan Lever, Reliance, Infosys, correct? And those five stocks. And if you don't invest in those five stocks, you're missing the growth engine of Indian stock market, correct? Now, the growth engine of the world stock market is NASDAQ and US. Now, if you don't invest in those, you're missing, and you're investing only in the 2% of the stock market, you're taking extremely high risk. So, geographical diversification, sectoral allocation, and quality. Now, today, if you want to do this in a correct balance, not many ETFs are available in India for having a geographical diversification. I'll share more details what kind of ETFs are available, and not many sectoral ETFs available. So the only option for an investor to have this thing proper today is balance is a mutual fund. And if you're investing only in direct equity, you don't get the exposures to all Microsoft, Google, Apples of the world, correct? Then also the other thing very important is when you're building a portfolio, the person whom you are working with should have a knowledge of the global markets, correct? Because nowadays only having a knowledge of local market is risky, because tip-based investing days are gone. Now it's the knowledge-based investing. You need to understand the global economy. You need to understand the global trends and which sectors. In 1980s and 1990s, any stock you buy, they used to go up. So I've been investing in stock market since 1975, 77, sorry, not 75. And in those days, any stock you buy, they used to go up. Any stock, no matter, small, large, then 1990s it changed. After 2000, only 50%, 60% stock market were working. Now only 20% stocks, or not even 20, even less than 5% stocks give positive return these days. So the world has changed, correct? So you require more knowledge to pick up the winners than losers. So you need to know more about the sectors nowadays than the stocks. So that the person with you're working, they should know all this kind of stuff. The other thing is the platform which you're working on, correct? The platform, today everything is digital. So we recommend, simplicity is 100% digital. Everything should be digital investments. Don't do paper-based investments. It's very risky nowadays. So in COVID times, those who had done paper-based investments in mutual funds, they didn't have any options if they wanted money, because everything was. But those who were digital, it didn't matter, correct? So today, if my all my investments are digital from any part of the world, I can buy or sell. That's the so the platforms are also very important. Then you need to understand your emotional intelligence, how you react when most of the people react on headline news. So these days, what happens is WhatsApp has become so popular and sensational. So one report comes, oh. COVID, especially in the month of March and April, so many people, markets are going to go down to 10,000. Sensex is going to go to 10,000. And those kinds of newses were floating, rumors were floating. People used to come and sell their entire portfolio at a lower level, correct? So sensational news. Now you get news that this guy, such and such event is going to happen. People buy stock. You should not do that. So you, when based on this, so how your behavior on headline news, you should invest on a trend basis, correct? Now many people have certain biases against certain sectors. That's also not good. Then investments should be always done based on research and long-term trends. So that's the behavioral analysis of every human being, correct? Now this is, I'm explaining in detail all the difference between direct equity, ETF, and mutual funds, correct? So popular in India, direct equity is the most popular mode of investments. But what then ETF is hardly popular. Hardly anyone knows about ETFs, and I'll share that reason why. And mutual funds are quite popular, but direct equity is the most popular. Translation to trade, people, when they invest in direct equity, 99% people want to trade. Very few people want to invest, especially among the youngsters. ETFs also trade. You can buy a sector fund on ETF today and you can sell tomorrow, but that's not the case in mutual funds. So when it's not so easy to trade and it forces you to invest, you get better returns. So that equity is very easy to understand. Very knowledge is required less, correct? So randomly people buy any stocks. When you're investing in ETFs and mutual funds, there are a lot of disclosures and knowledge is easily available, and knowledge is required is more quality wise. This is random. ETFs quality is high, mutual funds quality is high, because most of the ETFs and mutual fund, they'll pick up large cap and leaders in that sector. Whereas when you're buying a stock, your temptation is to buy cheap, correct? So you don't buy expensive and quality stocks, you buy cheap stocks. So that's why the impact of headline news is very high in equity, whereas it's very low in mutual funds and ETFs. Probability of investor making money in direct equity, I have seen in my last 40 years of career that less than 5% people make money in equity consistently. Whereas in ETFs, it's very high, 60%. In mutual funds, it is 80%. So over a period of 5 years, so in today, at simplicity, everyone is making money, correct? The probability is very high but if you are in stock market, the probability is much lower, because the entire market is not performing, only certain segments are performing. So cost of managing the portfolio is almost same, 2 to 3% everywhere. ETFs also the same, because if you add the brokerage and everything, it will cost you the same. Ease of monitoring is very low here. In direct equity, you have to personally monitor. Yeah, ETFs and mutual funds, professionals are monitoring them, so the monitoring is very high there. Benchmark, there is no benchmark when you buy equity, but there is a benchmark in ETF index and mutual funds also. In equity, you can borrow money, you can play options, futures, you can take a bank loan, whereas that's not the case easily in ETF and mutual funds. The people who prefer direct equities get rich quick. So Zerodha is very popular. In America, Robinhood is very popular because people like to trade, correct? And I have seen younger generation who like to trade, they never make money. They're very emotionally headline news driven investments. Who buy ETF? Mostly super high net worth families and mature investors buy mutual funds. That's what the trend I've seen. Your equity portfolio should never be more than 5 to 20%, because if you your ETF should be 0 to 15%, and 80 to 90% of your capital should be in this way if you want to build a large corpus. So this is the difference. Now, what kind of ETFs are available in India, correct? So currently, in India, the total ETF market is $20 billion, but the global ETF market is $7 trillion. In India, less than 350 ETFs are there. In America, more than 8,000 ETFs are there. So ETFs are very popular in America compared to India. In India, I'll just share with you what kind of that's the next slide. ETF performance, if you see in US, this is the performance of US. There was $500 billion invested in ETF market in 2005. Today it has gone to $7 trillion. And ETFs have given 18% return over a period of last 15 years, which is very good return, 10 years. In dollar terms, very good return. Especially in last 3 years, ETFs has performed very well because of technology. And US stock markets have really performed well in last 5 to 6 years. They didn't. Now, India, what kind of ETF available? There is a Nifty ETF. So, instead, what is Nifty ETF? You buy one Nifty. So, whatever in Nifty, the shares, if Reliance is 13% in Nifty, so if you're buying $1,000 rupees worth of ETF, you will get 13% will be Reliance, 8% will be TCS, 5% will be Hindustan Lever. So those kind of Nifty ETF is there. Then banking ETF is there. Then there's a gold ETF. Okay, so gold ETFs are very popular. I think they are the most popular ETFs available in India. Instead of buying physical gold, I would recommend, if you're doing it to invest in gold, you buy a gold ETF. It's a very good way of investing. I think this is the most popular ETF in India today. Then there's a mid-cap ETF. Then there's a Bharat ETF, which Government of India created for most of the pension funds investments and offloading government securities, correct? Then government security, GSEC ETF, this is a debt fund. Then there's a 4 Sensex ETF. There are 3 information technology ETFs. There are value ETF, blue chip ETF, 2 international ETF. There are only 2 international ETF. One is NASDAQ and one is Hang Seng. So you can buy a Hang Seng index in India. So if somebody wants to invest in Hong Kong Stock Exchange the index, you can buy that. It's not at all popular, but NASDAQ index is gaining traction nowadays. Then there's a large cap bond ETF, consumption ETF, dividend, infrastructure, mid cap. So there's a Sharia ETF. So this is for people who don't want to invest in banking stocks. And certain religions, they don't want to invest in those kind of stocks, correct? And small cap. So their total number of ETFs is only 88 as of today. Only 88 as against 7,000 in US. I anticipate in next 5 years, you will see a lot of ETFs coming to India. And it will be flooded. Now, so it will confuse a lot of investors where should they buy stocks, they should buy ETF, or they should buy mutual funds. And that's the reason I am doing this webinar today and creating awareness of it. Now, what are the roadblocks to ETFs in India? There is lack of marketing channel and lack of quality ETFs. So most of these ETFs are index-based ETFs, and they are not actively managed ETFs. So what I mean to say is segments, thematic ETFs, so healthcare ETF, FMCG ETF, those kind of ETFs are very popular. So like in US, I can buy a Russia ETF, I can buy India ETF, I can buy oil ETF, I can buy defense ETF, I can buy COVID ETF. There's a COVID ETF also in America. So all COVID related stocks are there. Stay home ETF. There's a ETF which has come on, stay home work ETF. So because of stay home and work is getting popular, all company stocks related to stay home ETF has been created by someone. So these are theme-based ETFs, correct? Those kind of ETFs market has not been developed in India, but you may see that in next 2 to 3 years. So there is a. I give you another example. There is a ETF called Innovation ETF in US. So it invests only in innovation companies, companies which are innovating, correct? So Tesla, Zoom, they are all innovating, correct? Square, they all. So this kind of ETFs are there. Genomatics, then fintech ETF. So Google, so like in India, Paytm, correct? Those kind of fintech companies are in this kind of ETF. 3D printing ETF. Now, that those kind of ETFs have not come. Now, this theme-based ETF, I'm just giving you an example. There's a technology ETF. This technology ETF has given 48% return in last 1 year. Now, you can participate in this kind of ETF. In India also, the technology ETF would have given 48%, which has 50% return in last 1 year, which includes Infosys, TCS, and so it's only technology-related stocks all combined together, correct? Now, these are very popular in US. So this is a global ETF, which has Apple, Microsoft, Facebook. Now, you see the returns you get on that. And I'll compare a global mutual fund here. This is a global mutual fund. Again, having those kind of same stock. Now, that also has given last 1 year 35% return and 15. So as an investor, here mostly people, the total investments in this mutual fund is $130 billion, whereas the other ETF which I showed you, technology ETF, the investment was only $35 billion. So if you want to create a long-term wealth through SIPs, this kind of ETFs, mutual funds and ETFs are quite popular, and basically they are more thematic and more theme driven, and the same kind of investments will be there. Now you see this mutual fund which I shared with you, Contra Fund. Even I have investments in this fund in my retirement account. This has emerging market, you see here, 2%. In this they have three stocks of India: Reliance, HDFC, and which is the third one? I think Kotak Mahindra. Yeah, these are the three. Now see the return. You see the companies, correct? Global portfolios. Now, same kind of stuff is available. All this kind of stuff is available in India, but people are not aware of it. And you should invest in this kind of theme-based investing through either mutual funds or through ETFs, but there are very few selected ETFs. You should be very selective and build a portfolio. The future is very bright for financial markets and investors in India. The COVID has brought a new boom to the financial markets, as more and more people have now become extremely aware that the role financial assets play in their life. And so I see a very good days ahead for next 2 to 3 years to make good money in financial investments in India and globally. With this, I end my today's webinar, and I'll take questions. Feel free to ask your questions, and if you like today's webinar, do subscribe to our channel. I'll be doing this every 2 weeks or 3 weeks. This time I'm doing the webinar after 3 weeks, and let's see what questions I've got. Yeah, feel free to ask me, text the questions. Yeah, and with this US elections, next week we'll see a little bit volatility, but it will be, if markets come down, it will be good to invest, correct? It will be a good time to invest. Yeah, let me see any questions. It seems then. Okay. With this, I end my today's webinar, and Okay, so you're sorry. How about small caps? What about small caps? Yeah, small caps uh, have taken a beating in the last 2 years. Um, they should recover, but I don't think they'll outperform the market. Now, small caps always rally at the end of the bull market. When the bull market is about to end, at that time the small market rally the most. Uh, Now, in the beginning of the bull market, the large caps rally. So we'll see. Yeah, in the beginning, so just now, think the rally will start more with large cap. Uh, yeah. This the small caps will rally, but they'll underperform. They'll underperform the overall market. Now, the next question is, what is the role Zerodha uh, playing? Correct. So, Zerodha, Robinhood and Zerodha are attracting a lot of youngsters who like to play the stock market while working, correct? And they are attracting a lot of, which is a good thing, which is a good thing. So they are expanding the market and reaching the market. But mature investments, as their portfolio is becoming big, people move from Zerodha and Robinhood, and they move to other platforms, correct? But Zerodha and they're creating a lot of good awareness of the financial markets in India, which is a very good thing. Mm, yeah. I don't see any more questions for today. With this, I end my webinar and thank you for your time and look forward to see you after 2 weeks. Thank you.